Everyone keeps asking how this happened so fast, and the truth is, it didn't. This has been building for years. The only thing that changed this week is that the people who normally control the narrative finally lost control of the price. And when that happens, history tells us exactly what comes next. They don't admit defeat. They don't allow honest price discovery. They pull levers. They change rules. And that is precisely what unfolded today. While most traders were glued to their screens watching silver push toward the mid-80s, something far more important was happening behind the curtain. Not on a chart, not on Twitter, but inside the machinery of the financial system itself. Early this morning, the CME group quietly released an emergency advisory, notice 26019. To the casual observer, it looked like another dry procedural update, the kind nobody reads. To anyone who understands market structure, it was a flare shot into the sky. Effective immediately, the CME altered how margin requirements are calculated for precious metals. They abandoned fixed dollar margins and moved to a percentage of notional value. For silver, that percentage was set at 9%. That sounds harmless until you do the math. With silver trading around $85 an ounce, the cost to hold a single futures contract jumped by roughly 15% overnight. Margin went from about $500 to more than $38,000 per contract. Nearly $6,000, due immediately. That is not a tweak, that is a shot collar. Why now? Because yesterday, silver didn't just rise, it went vertical. It gapped from $82 straight through $85 and briefly kissed $86 during the electronic session. For the commercial banks sitting on massive paper short positions, that move was existential. Another few dollars higher and margin calls wouldn't just hurt, they would cascade. The system needed buying pressure to stop immediately, and when you can't stop demand, you attack leverage. This is how exchanges force the issue. Every trader using borrowed money is suddenly given a very simple choice. Wire in thousands of dollars in fresh cash right now, or we liquidate your position for you. It's not subtle, it's not market-driven. It's a liquidity drain by design. The same playbook was used in 2011. The same one was used again in 2020. Different year, same reflex. For a brief moment, it looked like the tactic worked. If you watched the short-term charts, you saw it. Right when the margin news hit the terminals, silver dropped hard, from $86 down to around $83.50. Those red candles weren't emotion. They weren't fundamentals. They were algorithms and forced liquidations reacting to a rule change. That was leverage being flushed out of the system in real time. By tonight, the headlines will tell you the rally is over. They'll point to that candle and say the market has spoken. They'll say the bubble popped. They'll want you scared enough to dump your physical metal because a screen price flickered red for a few minutes. But here's the part they don't want you focusing on. Look at what happened next. In 2011, margin hikes crushed silver. 5 increases in 1 week sent the price down nearly 30%. $50 DAP became $35 in a matter of days. It was brutal. Today, we got a single margin hike of about 15%, punitive by any standard, and the price fell $2.50. That's it. And even that drop didn't stick. Look at the final candle. Look at the wick. Price dipped into the low 83s and was immediately bought. As of this recording, silver is holding around $83.90. It refused to roll over. That matters more than any headline ever will. This was the system firing one of its most powerful weapons directly at the market, and the market barely flinched. That is not weakness. That is strength. The reason this time is different is simple, and it has nothing to do with charts. The buyers sitting at $83 are not speculators. They are not day traders chasing momentum with leverage. They are industrial consumers, sovereign buyers, entities paying cash. You can't margin call someone who wires the full amount. If a manufacturer needs silver for electronics, batteries, or solar components, the CME margin policy is completely irrelevant. They're not gambling on futures. They're securing supply. When the price drops, they don't panic. They smile and buy more. That's why margin hikes don't stop physical demand. In fact, they help it. They shake out weak hands and deliver cheaper metal directly to the strongest buyers in the world. The paper longs get punished. The physical longs get rewarded. 2 markets, same ticker, totally different realities. This is the clearest confirmation yet that silver has split into 2 separate systems. One is the paper market, leveraged, rule-driven, constantly adjusted to protect insiders. The other is the physical market, governed by scarcity, logistics, and real-world necessity. You can manipulate one for a while. You cannot manipulate both indefinitely. And if the margin hike was the financial panic response, what happened out of Washington today was the political one. While the CME was busy rewriting the rules of its casino, the U.S. Treasury was doing something far more alarming, asking for help. We've now received multiple reports that Treasury Secretary Scott Bessent convened an urgent, unscheduled meeting with G7 finance ministers this morning. Officially, the topic was securing and diversifying supply chains. That phrase should make your ears ring. Government's Don T call emergency And suddenly the world's most powerful financial bloc is scrambling to talk supply chains. When officials say they need to secure supply, it means the flow has stopped. When they say diversify, it means they are dangerously dependent on countries they don't control. Diplomatic language is polite by design, but once you learn how to read it, it becomes brutally honest. Silver production and refining are not evenly distributed. China is a top producer and the dominant refiner. Russia is a major supplier. Mexico and Peru are critical sources. These are not jurisdictions the G7 can simply command. And when physical silver disappears from the market, no amount of financial engineering can conjure it back into existence. The margin hike was meant to buy time. The G7 meeting tells you they know time is running out. This is what systemic stress looks like. Not a crash, not a headline panic, but emergency meetings, rule changes, and quiet admissions hidden behind bureaucratic language. The system is straining under a problem it can't solve with spreadsheets or leverage. They can change the rules of the paper game. They can force liquidations. They can lean on price for a day or two. What they cannot do is print silver, and they cannot force cash buyers to stop buying something they desperately need. So if today felt chaotic, good. Chaos is honest. It's what happens when a tightly controlled system starts losing grip. The most important takeaway isn't that silver dipped. It's that the strongest weapons they have no longer work the way they used to. And once that realization spreads, the next phase doesn't need leverage at all. If you step back from the noise for a moment and look at the board the way policymakers do, the picture becomes uncomfortably clear. The balance of power in silver is no longer theoretical. It's geographical. A massive share of global supply, refining, and downstream control now sits outside the Western financial system. And today, the G7 finally had to admit, quietly, diplomatically, and a little desperately, that they are no longer in charge of the flow. This morning, Western finance ministers weren't staring at charts for entertainment. They were watching metal physically disappear. They saw Shanghai pulling silver out of London and New York like a vacuum cleaner with the bag removed. They saw retail demand emptying U.S. mints faster than they could restock. And at some point during that meeting, the uncomfortable realization set in: the West has no buffer left. The United States sold its strategic silver stockpile decades ago. Not trimmed it, sold it. There is no emergency reserve, no vault waiting to be opened in a crisis. The entire system runs on just-in-time delivery, a philosophy that works beautifully right up until the moment it doesn't. And as we've been warning, just-in-time is finished. The world has shifted to just-in-case. The problem is, the United States suddenly realized it has no case at all. This panic didn't appear out of nowhere. It connects directly to events that many people misunderstood earlier this month. Think back to January 3rd and what was branded as Operation Absolute Resolve in Venezuela. You were told it was about democracy. You were told it was about stability. We told you it was about resources. Oil then, metals now, same behavior, different input. When an empire starts moving aggressively to secure raw materials, it's not confidence, it's scarcity anxiety. 10 days later, that same anxiety has migrated into the metals market. Silver is no longer just an investment problem. It's an operational problem. You cannot run a modern military, build a green energy grid, and maintain a digital economy without enormous quantities of silver. This isn't optional. Modern warfare is electronic. Every missile guidance system, every advanced fighter jet, every drone swarm, every satellite constellation depends on silver's unmatched conductivity. There is no substitute that performs the same job at the same scale. If the supply chain snaps, and dealer delays suggest it already has, the military-industrial complex doesn't slow down. It stops. That's why the Treasury Secretary is personally involved. This isn't about coins or collectibles. This is about national security. And when you view it through that lens, today's coordinated response suddenly makes sense. First, the financial arm acts. The CME raises margins to smash the paper price and flush out leveraged participants. That doesn't fix the shortage, but it buys time. Then the political arm steps in. The Treasury convenes the G7 to coordinate how to secure physical metal outside the open market. This isn't free market capitalism anymore. This is cartel behavior. They want to coordinate with allies, Europe, Japan, Canada, to lock down mining output in friendly jurisdictions like Mexico and Peru before China absorbs it all. And the irony is painful. China has been doing exactly this for years. While the West was busy optimizing ESG scores, inventing new derivatives, and congratulating itself on financial innovation, China was signing long-term offtake agreements and investing directly into refining capacity. They weren't speculating on silver. They were securing it. That's why today's G7 meeting is not a display of strength. It's an admission of weakness. If they already controlled supply, they wouldn't need to meet. If the market were functioning normally, they wouldn't need emergency coordination. The timing alone tells you everything you need to know. Silver spikes, and suddenly the highest levels of government are scrambling to secure it. That $86 price wasn't a bubble, it was a flare. Pay close attention to the language shift. For decades, silver was dismissed as a shiny rock, a barbarous relic, something for jewelry and hobbyists. Now, almost overnight, it has been reclassified as a critical mineral. That is not accidental. Once something is labeled critical, it becomes eligible for government intervention. It opens the door to the Defense Production Act. It allows authorities to prioritize industrial and military allocation over private ownership. And yes, it lays the groundwork for rationing. If a defense contractor needs silver for missile systems, and a tech giant needs it for batteries, and you want it to protect your purchasing power, guess who wins that conversation? Missiles and batteries, every time. That's the uncomfortable direction this is heading. The public doesn't get invited to scarcity management meetings. The public gets managed. You've already seen the early signs. Purchase limits, premium spikes, sudden shortages at big box retailers, a growing narrative about hoarders. This isn't about fairness, it's about control. They want the metal, and they would prefer you didn't have it. That's why a $2 paper drop caused by a margin hike should not discourage you. It should clarify things. The same institutions leaning on the price are holding emergency meetings to figure out how to obtain the very asset they are trying to make look weak. That contradiction tells you everything. The margin hike was the distraction. The G7 meeting is the confession. And it's not happening in isolation. Bond markets are already flashing warning signs, as we saw with India's recent moves. Now commodities are joining the rebellion. Policymakers are fighting a two-front war against economic gravity, and gravity has a long track record of winning. Here's the part that really matters. None of these tools create supply. Paper tricks don't dig mines. Diplomatic meetings don't refine ore. You cannot legislate a silver deposit into existence. From discovery to production, a new mine takes close to a decade. No communique, no emergency session, no strongly worded statement changes that. You can hear the frustration in the system's response. The financial tools are blunt, the political tools are slow, and the market is moving faster than both. Which brings us to the most important question of the day. Why didn't it work? History says margin hikes break markets. In 2011, they crushed silver. In 2020, they amplified the pandemic crash and drove prices into the low teens. When the cost of leverage rises, players are supposed to fold. That's the script. But today, the players didn't fold. They called. Silver dipped into the low 83s and it bounced. It absorbed the blow and stood there, stubborn and uncooperative, like a heavyweight who just got hit clean and smiled back. That shouldn't have happened, unless something fundamental has changed. It has, and it's 7,000 miles away. While New York was busy selling paper, the Shanghai Gold Exchange fixed silver at 93.31. That's nearly a $10 spread between East and West. In previous cycles, that gap didn't exist. In 2011, prices across major exchanges moved together. The market was unified. When New York sold, everyone sold. That world is gone. The market is fractured. The West trades promises. The East trades metal. And as long as Shanghai is willing to pay over $93, there is a hard floor under the Western price. Not because of sentiment, but because of arbitrage physics. If the CME somehow smashed silver to $70 while Shanghai stayed at $93, that wouldn't end the bull market. It would turbocharge it. The $23 arbitrage spread is a gift. Traders wouldn't panic. They would back up trucks. Metal would flow east at record speed. Comics inventories would be drained in days, not months. That's the Shanghai Shield. It's not a theory. It's a pressure valve that turns Western manipulation into Eastern accumulation. The harder the West pushes down, the faster physical supply disappears. This is why today's interventions failed, and it's why the next ones will fail too. The door isn't just closing, it's already off the hinges. The system knows it. The G7 knows it. The CME knows it. The only remaining question is whether you're watching this unfold in panic or preparation. At this point, the irony is almost painful to watch. The banks are trapped in a position entirely of their own making, and there's no elegant exit. Every move they consider comes with a cost they can no longer afford. If they smash the paper price, the physical metal disappears into Asia at a discount. If they allow the price to rise, their short positions bleed into outright insolvency. They are no longer managing a market. They are choosing which limb to sacrifice. And the data released this afternoon confirms exactly which choice they're making, whether they want to admit it or not. While screens were flashing red and commentators were celebrating a so-called price reset, something very different was happening behind the scenes. The vaults were being emptied. Not figuratively, literally. The depository statistics published by the CME today read like an inventory report from a besieged city. Asahi, over 500,000 ounces gone. Brinks, more than 600,000 ounces withdrawn. CNT, another 350,000. StoneX, nearly 800,000 ounces removed. Added up, and you were looking at more than 2.2 million ounces of silver leaving the COMEX system in a single day. That alone would be notable. But the real tell is where the damage occurred. The registered category, the silver available for immediate delivery, fell by almost 400,000 ounces, dropping to roughly 123 million ounces. That's the bloodstream. That's the metal that actually matters. And it's leaking. The margin hike didn't stop the bleed, it accelerated it. By forcing the paper price down into the low 83s, the exchange unintentionally put silver on sale for the very entities draining the vaults. The CME tried to starve demand and ended up feeding it. That's not strategy, that's self-harm. This ties directly back to the emergency conversations happening at the G7 level. Treasury Secretary Bessent doesn't need a chart to understand what's going on. He sees the same inventory reports. He knows metal is flowing west to east at an accelerating pace. That's why the language coming out of those meetings revolves around securing supply chains. They are trying to build a fence around a market that already has a $10 price gap in it. And here's the problem with fences. Capital doesn't respect them. Metal doesn't either. It flows to where it's valued most. Right now, the place is Shanghai. This is why volatility should not scare you. When you see a sharp red candle, understand what it's actually hitting. There's a floor under this market, and it's not made of sentiment or technical indicators. It's made of a standing bid from the largest industrial economy on Earth. Unless the price in China collapses, and there is zero evidence of that given domestic demand, the price in New York cannot fall meaningfully without triggering massive arbitrage flows. In effect, the arbitrage acts like a built-in put option. Downside is capped by physics. Upside is open-ended because the shorts are structurally broken. That's a powerful asymmetry, and it didn't exist in previous cycles. What we are witnessing is the fragmentation of global price discovery. For a century, New York dictated the price of silver, and the rest of the world followed. That era is ending in real time. Today, Shanghai sets the floor, and New York scrambles to defend relevance. The margin hike was an attempt to remind the market who was in charge. The market checked the Shanghai fix at $93 and collectively realized the emperor was underdressed. Paper tools, margin hikes, spoofing, wash trades only work when physical demand is dormant. That condition no longer exists. The physical market is awake, aggressive, and consuming inventory at a pace the paper system cannot replenish. Those 2.2 million ounces that left the vaults today are not coming back. They won't be rehypothecated. They won't be eligible again. They're being melted, fabricated, installed, and deployed. Solar panels, electronics, defense systems, finished goods. End of story. So now we reach the uncomfortable question for the establishment. What's left? Margins didn't crash the price. Policy meetings didn't stop the outflow. Supply can't be conjured. Mines take years. The only remaining lever is access. If you can't control price and you can't increase supply, you restrict participation, you close the exits, you make it harder for the public to get involved. And we are now watching that phase begin. Look at the retail side. For the past 2 years, Costco quietly became one of the most important silver distributors in the United States. Tubes of eagles, bars, easy access, high trust. That model changed this week. Verified reports now confirm that Costco has imposed strict limits on silver purchases, 1 transaction per membership, hard caps on quantity. Think about how unnatural that is in a free market. When demand surges, businesses normally celebrate. They raise prices and sell more. You only limit sales when you're afraid to replace what you're reselling. Costco understands that if they allowed unlimited purchases at these prices, their entire national inventory would be gone in hours. This is rationing. It's polite, it's quiet, but it's rationing. Now look at the U.S. Mint. The institution tasked with supplying the public with official silver coinage released the 2026 Silver Eagles, and they re-gone immediately, back-ordered. A full month delay announced. Let that sink in. The United States government cannot stamp 1-ounce coins fast enough to meet demand. That's not a marketing issue. That's a supply chain failure at the sovereign level. This is what happens when, just in case, panic collides with a system built for just in time. And the most technical, most revealing signal of all is unfolding inside the futures market itself. We're seeing backwardation and, more importantly, backward rolling. Normally, as contracts near expiration, traders roll forward, out of the delivery month and into the next. Routine, boring. But that's not what's happening. The CME's own open interest data shows something deeply abnormal. We saw 369 delivery notices issued for January, yet open interest only declined by 233 contracts. Translation: traders are fighting to stay in the delivery month. For every participant trying to exit, someone else is forcing their way in. They want January metal, not March promises. Why? Because they don't trust that the metal will still be there later. This is the textbook definition of a squeeze. Shorts are trapped. Longs are demanding delivery. The exchange is hiking margins to pry them apart. And it's not working. So what is the verdict on this day? The system fired its biggest financial weapon, a 15% margin hike, and silver is still trading near 84. The Treasury convened the G7, implicitly admitting vulnerability. Retailers have begun rationing. Inventories are draining. The warning lights are flashing everywhere. Today was not about price suppression. It was about psychology. They wanted fear. They wanted capitulation. They wanted that red candle to break momentum and confidence. Instead, the market absorbed the hit and stood its ground. That $83.90 price is not arbitrary. It's symbolic. It marks the moment the market collectively understood that paper control no longer overrides physical scarcity. If you already hold physical silver, the message is simple. Donati let rule changes scare you out of the only asset the system itself is scrambling to secure. That metal is not an investment. It aims insurance against the very crisis policymakers are now openly trying to manage. If you're still looking to buy, understand the environment has changed. The easy access phase is over. Costco is limiting. The mint is delayed. Premiums are climbing. Availability is tightening. What remains will not be evenly distributed. The technical path forward is clear. The resistance around $80 is gone. The test of $85 didn't break the market. The next gravitational point is the Shanghai price in the low 90s. That gap will close, not because of hype, because of arbitrage math. The empire tried to strike back today. It used margins, meetings, messaging, and it missed.